This Twin Peaks Investing podcast is brought to you in association with ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.
Hello and welcome to the Twin Peaks Investing Podcast. My name is Peter Higgins. This is podcast number 141 and it's currently 6:45 on the 27th of November. Crikey, we're almost in December, almost heading to Christmas, Henry. Yeah,
it
another
comes
year.
round fast.
And it's come round fast, mate. Oh boy, boy, oh boy, oh boy. Right, where should we start this pod?
Where should we start? Well, I think so. I mean, we were there, it seems like ages ago, but it was only, what Tuesday? Last Tuesday?
Yeah. Last Tuesday, we were at Mello, it's Mello Derby, 10th anniversary of Mello. It was absolutely freezing. I think that was the first day that the snow dropped in Derby and the Midlands. And the trains decided they weren't going to run. So everyone was late. I think X amount of people didn't make it at all to Mello. But I think I really enjoyed it. So yeah, it was really, really good. Met loads of nice people, of which I'm going to give a shout out to a few. Met once again James. You can follow him on Blue Sky Social. Met Lester Pete, lovely chap who lives in Leicester, also called Peter. Trader Mark, met him for the first time. A lady that I've spoken to many, many years ago and I haven't spoken to for a good while. It was lovely to see. Travelled all the way from Scotland. Brigitte Murray, I think you got to speak to her as well.
I did, yes. Very nice.
In fact, I think she might have bought you a Guinness, mate. I think you're a Guinness.
She did. I owe her a Guinness the next time I see her.
Ladies and gents, I think Henry owes everybody a Guinness because he was drinking them like it gone out of fashion.
I wasn't quite getting carried round the bar, but it was a close thing.
Not quite. Sukhbir Kapoor, met Sukhbir, lovely chap, lovely to meet him. Met Jan Scholes from Goldcore again for the first time in ages. And I actually travelled in the taxi with Ben Rogoff of Polar Cap, which was also very nice. And enjoyed his presentation. The presentation from Mortgage Advice Bureau's Deputy CEO, Ben Thompson. And we were fortunate to have Premier Mighton's fund manager Gervais Williams in our actual presentation, Henry.
We were. I was amazed.
All the other people that we met were very, very courteous to us, very nice to us, and said great things about the pod.
Well, I'd have been terrified if I'd known he was there. He nodded to me afterwards, and I thought, oh, he recognises me. Why does he recognise me? And when you said he was sat in the room, I thought, flipping out. It's a good thing I didn't come out with anything too outrageous. You forgot our good new friend Mark Coplow, who we met right before we went live. Yeah, very nice chap.
Of course.
We had a fantastic conversation with him, and he later wrote in, which was very nice. So hello to Mark if you're listening to this episode. Hope you're well.
Absolutely fantastic. Yeah, Mark was lovely, and we met loads and loads of people. It was great to just meet people that haven't really are not online. We met so many people that weren't online, didn't we?
Yeah,
it was amazing. Not on X, not on Blue Sky Social, and really, really receptive to us being there. Comments that I had was one of their favourite aspects of the 2 days was our alternative presentation. Got to give a big shout out to Paul Hall and Matt Bellet, who absolutely stole the show for us. Paul came on the stage with us and delivered the podcast with us, and we interacted with all the different screens that are on ShareScope. So that was really good. I think can we go through what we actually did on the day, Henry? I think that'd be useful for people.
Yeah, I mean, as a rule of thumb, I don't think it's worth going too deep dive into it. But
yeah,
I think it was really useful to have somebody there showcasing the SharePad platform, like you say. I mean, when we're doing these podcasts recorded, you're in Leicester, I'm in London. We've got us on the screen, but you don't necessarily see the platform. And actually, recording this episode at Mello meant that we could have a big projector up behind us. And so, as we were talking through the various companies, Matt was whizzing around in the background doing all these interesting things with the software and showing people what it was we were talking about, which was really pretty cool.
It was brilliant. So we discussed Bloomsbury, which Henry and I both feel is a really, really good company. And in my view, it's going to have another strong December going forward, because it's obviously seasonal sort of thing as well. So December, January, they should do quite well, and numbers could again surprise. So we showed all the data on the screen for that one in isolation, looking at all the different segments that you can actually look at, and basically then moved on to compare two stocks, didn't we, Henry? Yeah.
We did.
And the
Yeah, we had a
next
look at
two,
it was market
plus two
makers, wasn't it? Not market makers,
market makers, yeah,
brokers.
brokers, plus 500, and IG Group we looked at after that. And we ran the metrics on that one and compared and contrast. I chose not to talk about CMCX because I hold that one. And we basically discussed the merits of those two companies. Both of them look very, very strong, and they performed reasonably well. Yeah, and we spoke about the CEO making a big purchase. If you've not seen that, I think it was the CEO, what's his name? Brion Corcoran, who became CEO in January of this year. And then he made a large purchase of shares in September with regards to $1.22 million, the equivalent of £915,000 worth of shares at £9.15. So that was quite a good indicator to have found on IG. Obviously, I'm a bit biased with those because I own CMCX, which came out with numbers recently, which were reasonably good, but the market went, you've travelled too far, and tanked the shares by about 15 to 20% at one stage, I think. Henry, then we talked about Admiral and Aviva.
We looked at insurers, and I bored the audience to tears looking at the balance sheets and the income statements. For those of you that are more mathematically inclined, SharePad has got this wonderful data set effectively for any share you look at, and you can go back for, I think I went back all the way as far as 2003 to get a couple of economic cycles in, and you can see how income's broken down and how liabilities are broken down and assets, and you can really get under the skin of an insurer, which one of the points you and I were discussing was this idea that unlike a basic manufacturing business or a retailer, you actually have to get a grip with insurers of what it is that the business is doing financially, because otherwise you can just be opening up a whole can of worms and you don't know what you're letting yourself in for.
Absolutely. Yeah, so we compared those two, both look reasonable. We talked about the issues around the national insurance bit, national living wage also, and that being impacted because Admiral and Aviva have got stacks of employees. Admiral have got 13,000, and that we were saying that basically that could impact them. And also this current probe into the car finance side of it, could it impact both of them as well? We spoke about that, didn't we?
We did, yeah. I mean, this thing over national insurance is really blowing into quite a catastrophe. The Chamber of Business and Commerce, or whatever it is, had a conference today, and Rachel Reeves was there, standing on a stage saying, "Oh no, we really like business. We want you to do well." And immediately before her coming on stage, the chairman had been saying, "No government should ever do this to any business ever again. This rise in national insurance is just a ridiculous thing. There's going to be massive redundancies next year. What were you thinking?" So,
Fair point.
politics is moving at a fair pace around us.
Yeah,
Um,
it is.
and it's I don't know how much of it is a lot of squealing from companies that can take it, and how much of it is really going to be, yeah, we're going to hit April and there's going to be huge problems.
I suspect it's a bit of both. I think we're going to see some companies coming out with profit warnings or indicating that next year isn't going to be as strong going forward, Henry.
I think
So
so. I
we'll
mean,
have to.
it seems inevitable, doesn't it? If tax is a cost, and your costs you know are going to go up. You didn't
Mhm,
know they were going to go up 12 months ago when you made your original forecast. So,
yeah,
yeah, not
yeah.
great.
I had a brief chat with Paul Scott at Mello, and he was quite positive on the small cap space. And I'm hoping he and others are right in a sense of there's still value to be added or had in the UK market. Because I'll run some numbers by you here, Henry. We've got the FTSE 100 year to date up 7% or thereabouts. Okay. 1 year up 11.4%. Then you contrast that with the S&P 500, which is up year to date 25.7%. Yeah. And over
Yeah.
1 year up 31.7%.
The
Not
thing is, the
great.
thing is though, I mean, I mentioned this to you the other day. The thing with the S&P in the US right now, it's going absolutely gangbusters. I mentioned to
Yep.
you Palantir. Now, I don't
Yep.
hold Palantir, but I follow it. I'm quite interested in the business. It's on a forecast PE of like 90 times. It's on a price to
Yep.
sales of something insane. It does
Yep.
200 million in revenue, but it's priced as $150 billion market cap.
Yeah.
You
Yeah.
know,
Yeah.
it's priced out of any kind of proportion with what it's actually doing. And the price has gone from something like $5 back in the summer to over $60 the last time I looked at it. It's not 10x its revenue. And
Yeah.
there's so much of the US where you can point out examples like this. You look at Nvidia, that's priced for goodness knows what.
Yeah.
And I've got
He is
big
a he is
concerns
a
over
he
the
is a friend. The
US.
CEO Peter Thiel is a friend of Musk, and they
Wow.
backed Trump. They backed Trump. So everyone's thinking, and it's already started. They're getting contracts. Plenty are getting contracts from the Ministry of Defence and other people. Is it overvalued? Potentially. Could it go higher? Potentially.
Yeah.
Um, so yeah, my concerns regarding the US is that it's already had its Santa rally, and any sort of hiccup, it'll roll over and roll over quickly, as
Yeah.
we've seen with Bitcoin. And I'll read these stats to you now, Henry, which I think will make your ears stand up a little bit. Close of the market on the 26th of November. You've got, sorry, yeah, November 26th. You've invested $1,000 or £1,000 5 years ago. You ready for this? Nvidia returns to you £22,000 with your
Very
1K.
nice.
Tesla 17. Also that done in the last month. Yeah. Bitcoin 8,800. Microsoft 4,200. Apple 3,800. Now, is it any wonder there's a massive drawdown in UK equities and you're seeing such negativity towards US stocks, UK stocks, should I say, and positivity towards US stocks? So, yeah, we need to talk about some positives in the UK market. And the recent positives that was had, what day have we got now? It's last week. Last week we had some positives with I think it was 17% move in 1 day for Games Workshop. So we've got to shout out to all of those individuals that have been very, very patient with it. Because I did say what was that? I don't know, it was 3 years ago now. Or whenever it hit 120, I said to people, look, I think it's overvalued now. And the shares went eventually to 123 from 120. And then it eventually went down to sub 60. And it's come all the way back. I think it closed at 136 today. So anybody that's held through all of that, huge congratulations to them. And we'll see what other positive news can come
Well,
from it and whether it
they've
can
had some
continue.
roaring successes recently. I
They've
mean,
had some
they've just
fantastic
released a
success,
new
and
video game
it's gone from
that
being outside the FTSE 250 into the FTSE 250, and now it joins the FTSE 100. Remarkable journey for what
Creatively, they're
essentially
doing.
is a gaming company and figurines.
But I mean, they are much bigger than that. I mean, they've launched their own streaming service now.
Yeah.
They've got the streaming service, they've got a publishing business, they've got a books business, they've got the video gaming segment has just launched a hugely successful sequel to I think it was a 2010 game, Space Marine. They've just put out Space Marine 2, which looks fantastic. It's also priced at a fantastic price mark. So if anyone wants to treat me to a Christmas present,
Of course. I'm thrilled for Matt because we had Matt in September, didn't we? We had Matt in September on the pod, and Games Workshop's up nearly 40% for him since September.
Yeah.
So anybody else that bought around that time that Matt was on the pod are up over 30%, 30 to 40%.
Yeah.
So I'm thrilled for everybody that's in there, and congratulations to all those that held on throughout all of that time.
Well, it's hard to do it. It's just as hard to hold when things are skyrocketing as it is to sell when they're falling.
Absolutely.
And arguably it's actually easier to sell when they're falling because you just want to stop the pain. Whereas when they're skyrocketing, it's harder to stay put. I'll put it that way.
Absolutely agree. Right. So we've covered Mello and a few other bits and pieces. Any other pieces you want to cover, Henry, before I start talking about some stocks?
Well, there's one headline that caught my attention today, and on a slightly, I mean, it's a semi-serious note. It depends how interested you are in commodities, but apparently, coffee futures, and I should warn coffee lovers right now to sit down. Coffee futures have just hit a 50-year high. So the price of buying coffee beans is skyrocketing, which means your cup of cappuccino that costs, I don't know, £3.50 right now, might be costing £6 in a couple of months. If the price of coffee beans carries on doing this, who knows where we're going to end up. So massive problems with the exports, massive problems. We've had floods and we've had droughts, sometimes in the same areas. It's decimated the crops.
Still piling, mate. That's what's going to be happening.
Not good. It's really not good. So that caught my attention. But the other thing that caught my eye just before we came on air, and I suspect this story will have developed further by the time this comes out on Friday, but at about 5 o'clock this evening, might have been a bit later, Aviva announced that it has submitted a non-binding proposal to acquire Direct Line Insurance Group. They made a possible offer to acquire 100% of the shares, paying 112.5p in cash, and also issuing 0.282 of new Aviva shares for every Direct Line share that a shareholder owns. Little over half an hour later.
Sorry, what does it value it at then, Henry, per share?
Well, I've not calculated the Aviva price, so it's a fifth of an Aviva share plus 112.5p.
Okay.
So it's a significant premium. Within half an hour, Direct Line had then issued their own RNS saying, "What a load of baloney! We didn't solicit this offer. It massively undervalues us. We're not interested. We've rejected it."
They're going to drive at the best price they can possibly get, mate. They've not performed. I sold out of that.
They responded very fast. Was my observation.
Yeah. We should have gone for LGEN, which I've only just recently purchased again. So yeah, hopefully that'll get a pick up tomorrow from that shenanigans in there.
It won't be the last we see, I don't think.
No, I think Aviva will be doing Direct Line a favour, mate. To be honest.
Oh, it's been a dog of a share that I used to own.
Yeah.
And thankfully don't anymore. But
nobody wants to give up the jobs, Henry.
No.
Nobody wants to give up the jobs.
You take a takeover offer and you're out of a job the next day if you're on the board.
Absolutely.
This is a quick hello to you, our valued Twin Peaks Investing podcast listener. Whatever channel you're listening to, please make sure to subscribe and you'll always be the first to get the new episodes. Thank you for your continued support.
Yeah, let's talk about some value in the markets then, Henry, yeah?
Well, there's lots out there.
Yeah, and let's talk about a couple of stocks. I want to talk about my first pick of stocks here. Anyone wondering why I'm holding my head and hiding my mouth? It's because I've been poorly all week and my neck is sore and my back is weak. So I am actually dragging myself onto this pod. So wonder not. I'm just trying to hold my head up before I just drop like this. Yeah, because I think I picked up that bug from Mello. Lots of hugs, lots of shaking of hands, and the cold. It was bitterly cold.
It was
Walking backwards and
perishing.
forwards to
You're
Mello.
just doing too much, mate. You're doing too much.
Yeah.
You need to get your pipe and your slippers and sit down in front of the fire. Stop all this herring around.
Yes, I just might do that. Right, okay. I'm going to start with this first investment company pick for me, Henry. And it's a 10-year dividend hero. Keep picking these dividend heroes. I'm trying to show there's still quality out there. 10-year dividend hero. It's been increasing its dividends for the past 10 years. And it's called RIT Capital Partners, ticker symbol RCP. And it's annualized CAGR, total returns of 10.83% since inception from the 1st of January 1987. Their strategy is to invest in a widely diversified international portfolio across a range of asset classes, both quoted and unquoted, to allocate part of their portfolio to exceptional managers in order to ensure access to the best external talent available. The last NAV was 26 quid on the 31st of November. Sorry, 31st of October. And it's currently priced at £19. So it's a discount of £27. 20, brain's not working, a fire in here. Discount of 27% at the moment, yield of 2%. And what triggered me actually looking at this was a conversation I was having with Neil Shah of the London Stock Exchange. And we're talking about female fund managers. And who happens to be the CEO of this particular outfit? A lady called Maggie Faneri. I think that might be Italian, Henry, I'm not sure.
But he sounds like it.
She happens to be the chief executive officer of J. Rothschild Capital Management, which is obviously owns this subsidiary, which is RIT, is managed by. And it's got a very high caliber here. Previously senior managing director, global head of high conviction equities at Ontario Teachers Pension Plan, which is one of the largest pension plans in the world. And formerly, and I know you love this bit, Henry, worked at KPMG as well. So you know that this is a very talented lady, chartered accountant, CFA, charter holder.
Haven't KPMG just been sanctioned for failing audits by half a dozen governments?
I think she'd left. I think she left before they started doing all bad stuff.
Nothing to do with her, right?
Nothing to do with Maggie. So £10,000 invested in RCP, the ticker symbol, we're worth around, obviously it's 1987, so you can say what you want to say about it, around £35,000 today. So we went, you know what, let me just put this into my new grandchild's, whatever it is, newborn in 1987. That individual now have nearly 350k. Not bad. Some of the holdings we know about are National Grid, which is the main one, I think. And then they've got an interesting investment in Thrive funds and iconic funds as well. The interesting thing about Thrive funds is that they're one of the companies that invest in all of the Silicon Valley sort of startups, Henry. And they've got investments in, I believe, OpenAI, one of the most talked about unlisted entities at the moment. They're invested in Peter Thiel's Founders Fund, and currently via Thrive Capital, they're invested in Databricks, which is currently worth 55 billion. So if they can get some turnover regarding those IPOs, I think, or if and when they get IPO'd, or whether they carry on staying private and get that certain valuation upgrades, I think you could get that discount significantly reduced from 27% and see the share price up nearer to NAV at £26 versus what it is now at £19 per share. So yeah, nice exposure to private equity and listed companies. One of the ones that it's got here, I read about, I'm going to butcher this, so apologies, is a company called Coupang, which is classed as, or people tout it as, the Amazon of South Korea. Yeah,
Heard of
so
it.
Amazon company, the company, not the Amazon as in rainforest, but the Amazon of South Korea, and they've got a stake in that. So I just think maybe it's undervalued. It's a compounder as well. Yeah, so I might have a look at that myself. Thoughts?
Well, I know RIT Capital Partners really well, and I've looked in depth at this multiple times. It's traditionally associated with the Rothschild family, the banking
Absolutely.
dynasty, and they've got a really long record of managing wealth through a balanced multi-asset approach. So the whole ethos of this vehicle is not shoot the lights out growth. It's when you've got capital, we're going to protect it and grow it over the long term, which listeners will know is me all over. Which was why, I started trying to figure out what it is they're doing. But this has got some unusual risks to it, which I think are worth flagging. I mean,
Go for it.
it's got quite a complex portfolio, is the first thing I should say. So whereas most
Agreed.
investments you can go and look at the top 10 holdings, and it'll have Microsoft and Amazon and Apple and, whatever listed businesses that you can go and analyze yourself. RIT has actually got most of its funds in fairly complex and opaque assets. So things like private equity, you can't go and analyze a private equity firm. You just have to trust that the asset is valued correctly. They own stakes in hedge funds. Again, who knows what these guys are doing? They're off doing something. We hope they're not blowing up the world. Lots of illiquid investments as well. So they own lots of unlisted vehicles, unlisted equities, all kinds of unusual things. So it's quite a challenge as a retail investor to really get to grips with what you're investing in. You just have to trust that RIT know what they're doing with your money. The other thing I'd say is that this has come off the boil quite significantly. So it's always been marketed as this sort of wealth preservation tool, right? Put the money with us, it'll go up at 8-9% a year. It won't go down too much when the markets go down, but likewise, when markets skyrocket, it probably won't capture all the gains. That all fell apart when COVID hit. And all of a sudden, investors started noticing that there was a huge chunk of this portfolio in private equity marked at a certain valuation. And where public markets had come off the boil and dropped, these valuations weren't shifting at all. RIT Capital Partners went, no, we bought these at £1. They're now worth £5. Take our word for it. The market didn't like that. And all of a sudden, RIT swung from this huge premium. They were trading at like a 25% premium to NAV to the discount you just mentioned. I think it's now like a 25% discount.
27 plus,
27. So the market all of a sudden went, hang on a minute, you say trust us. We don't trust you to be marking your own homework here. We don't know what's going on with this part of the portfolio, and it's most of the portfolio. So there is that sort of managerial risk going on. You have to trust, you have to understand, first of all, what the management team are doing. That's quite hard to do. And then once you've figured out what they're doing, you've got to trust that they're doing it well. And that's quite hard to do. So if you take the long run story since 1987, did you say?
Yeah, 1987.
1987. this has been a fantastic compounder, right? No doubt about it. If you take it over the short term, last 3 to 5 years, this has really not performed. And I'm not sure quite what it's going to do next. So really interesting pick. And it's a name that you don't actually hear mentioned very often. But to anyone out there that researches our ideas, make sure you do your reading on this one, because there's a lot of detail to get into with it.
Absolutely. As with all the stocks that I talk about, it's all about research. It's about everyone going away and doing their own. I quite like the exposure to potential behemoth tech stocks, because I can't find these. I can't pick these myself. I can't get exposure to them myself. So at some point or other, once I've completed my research, I might just put some money away and just leave it there for my daughter and see what happens.
That's the whole idea of it. The other thing
absolutely.
that caught my eye with this, so when I looked at this a couple of years ago, and it is a couple of years since I've really dug under it, I walked away because it had a 5% ongoing charge. And I went, Jesus Christ, I'm not paying 5% a year for anyone to manage my money. Like, I'd be better off setting fire to half my bank account. Like, no thanks. Walked away, never came back. So
don't trigger me.
Having a coughing fit.
I'll have to check what the charges are now, because I forgot to look at that. Yeah.
According to the Association of Investment Companies, they're 0.77%.
Well, that's gone down significantly then. That's still high.
So either I've got the wrong figure, I was looking at the wrong thing, which is always a possibility, or someone slashed this to bits, or the methodology's changed.
Right, okay.
But if anybody out there wants to do some reading and write in, let me know your thoughts. I was under the impression RIT Capital Partners had a 5% ongoing charge. And everywhere I look, it's now saying 0.77%. So if you know, write in, let me know, tell me I'm an idiot. But that did catch my eye when I saw that.
Okie dokie. Rightio then, Henry. That's me done on that one. I think you've assassinated that one suitably enough. I'm far more bullish than you, long term on it. And I might well make a purchase at some point for the mini boss on that one.
She'll be a very, very, very lucky young lady.
Oh, she's spoilt, mate. She's spoilt. Right, over to you. What you got?
Well, sticking with the insurance theme, we were talking about insurance at Mello. Gentleman comes up to me after the show and he says, "Oh, there's a standard. They do insurance. Like, you need to go and talk to them. What do you think about it?" I said, "Hang on a minute. What? Slow down. What is this?" And he said, "No, look, you work in the insurance industry. You'll know all about this. This company, like, they're fantastic. They're amazing, right? You've got to go and have a look at them." And straight away, I've got alarm bells going off, because anytime someone comes at me like this, it's anyway. This company, when I started looking at it, he was right. And I don't say this very often when I get cold pitches. He was right. This has really interested me, this business. Now, I don't own any. I'm not going to go out and buy any after this podcast, like, immediately. So I'm not ramping this, but it really caught my interest. The business is Helios Underwriting. The ticker is HUW, Helios Underwriting. And they provide investors with exposure to something called the Lloyd's of London market. Now, for those of you that aren't insurance geeks, there's a big building in London called Lloyd's of London. And inside it are lots of insurance syndicates, people that actually issue insurance policies. Now, you and I can't go and invest in those syndicates. We don't have enough money. It's a very exclusive group of people that are allowed to put their money into Lloyd's of London and write insurance. But the returns can be absolutely phenomenal. You know, we're talking 13, 14, 15% annualized returns. The only trouble is when they have a bad year and there's a hurricane or an earthquake and they've got their pricing wrong, the losses also spiral. So you have to pick your syndicate, effectively your insurers, very, very carefully before you put any money into something like a Lloyd's of London syndicate. Now, Helios Underwriting provide exposure to this insurance market, Lloyd's of London. They've got an actively managed portfolio of syndicates, They've acquired over 75 companies with a total underwriting capacity, that's effectively claims capacity, of over £100 million. And most interestingly, they've outperformed the actual Lloyd's of London market by 9% over the last 5 years. So not only is this a really differentiated asset class, these guys are outperforming the market that they're operating in. So straight away, I'm seeing lots of things I like here. Now, Helios Underwriting, it's an AIM-listed investment company. And effectively, when you give them money, they take that money and they will go and put it with different syndicates. So you'll own it, like an investment trust will go and buy different assets, different shares all over the world. Helios Underwriting will go around the Lloyd's of London market and they'll buy you bits of different syndicates. That's what you're effectively buying. You're buying Helios Underwriting's ability to analyze those syndicates, buy at a discount in a hold for profit. Now, it's not a particularly expensive business. It's on a forecast PE of 9.5 times, so it's not it's not a Palantir. It's got forecast turnover growth as well of 51%, which to me is just astounding. Most of the businesses I hold, if they grow their turnover by 5 or 10% a year, I'm happy. 51% is the forecast for next year. And shares are available at about £2 a share as of the time of this recording. I think they're 207 or something. So, they've had a bit of a run. In fact, they've had a very good run. But this, to me, is one that's well worth investors going and having a look at. If you're interested in some diversification for your portfolio, I'm not saying, go and buy this tomorrow, but it was something that stuck out to me as being a very different sort of investment, but also quite a high quality name as well, which I like the look of.
It looks very interesting, Henry. Just one piece I want from you is, what do they cover? What insurance do they mainstay do they cover?
Well, the syndicates cover all sorts. So Lloyd's of London
Right.
issues policies in almost every class.
So is it reinsurance?
Their syndicates. They do reinsurance, but they also write their own policies directly.
Right. Okay.
So you really are, these 75 businesses, these 75 syndicates that they've invested in, they will cover everything from ships to cars to planes to people.
Oh, right. Okay.
Operating insurance, general liability, public liability.
So really quite diversified via all the syndicates. I get that now.
Effectively, the way Lloyd's of London works, you've got a group of brokers wandering around trying to fill policies, and people will put bits of money against the policy.
That's actually quite interesting, Henry. You went into the chat at Mello then? Is that what we said?
Yeah, well, I couldn't actually find Helios. That was the thing that really irritated me, because I came away from this guy going, right, I'll go and find Helios. And I think if they'd had a stand, they'd gone or something. So I never got a chance to actually talk to them.
Right. Okay.
So the gentleman that spoke to me was just another guest at the show, I suppose.
Yeah. I'm looking at this, and the numbers are quite remarkable, really. The last sort of half-year comparisons. Looking back at some data here, and they've had a fantastic 12 months, haven't they?
They really have.
Those numbers look a little bit of like outlier numbers. It's like something happened significantly to boost their numbers. It's staggering.
Yeah. And it's also, there are, I can't really overplay this enough. There are very, very strict regulations and restrictions to getting into the Lloyd's of London market.
Absolutely.
You and I you can't even get in the building as a member of the public. You can't just stroll in there and be like, oh yeah, I'd like to write some car insurance. Give me a box. You'll be ejected out of there in record time. Well, we certainly would.
Even if you are Henry Viola here, yeah.
Don't you know who I am?
Exactly. With your cane in hand, you know what I mean?
Yeah.
Strolling.
The answer would be no, quite quickly.
Still no. I'll have to have a look at that, Henry, because they've got market cap here of sub 150 million, so it's got room for growth there.
Yeah.
Yeah,
And
interesting.
it's the quality of it that gets me, because insurance is all about quality. I mean, any idiot can just wander out and start insuring things, but it's insuring them without taking a massive loss if something happens. That's the trick.
Yeah. I'm going to end up buying all these insurers, and that's the problem. What was the
So
divvy?
yeah,
What's the divvy
there's a
yield on it?
lot to like. And also
What's the yield
for
on it?
members of our audience that are concerned about inheritance tax, apparently the shares are eligible for business relief for inheritance tax.
Oh, don't tell everyone that before I buy it, Henry. Come on.
So there you go,
So,
you see. Because I mean, after the last budget, I've been asked about 1,000 times about inheritance tax. I'm not a tax advisor. I cannot give you tax advice. Go and see your own tax advisor instead of asking me for free.
absolutely. So the yield's around 3.3% at the moment, or thereabouts.
It's forecast at 6, I think.
6. Oh, wow, even better. Right. Okay. I'll have to research that over the weekend.
So a lot to
Really
like
good
there.
call, that one, Henry.
Thank
Really
you.
well done. Really well done. Right. Are you ready for another one?
Yeah, go on, shoot.
Okay. The nights
And
are
try
getting
not to
quite
sneeze
dark.
halfway.
Yeah, I'm trying to just keep my head up here. The nights are getting dark, and therefore my next investment, Henry, is linked to porn. Broking, Henry, broking. Porn broking, before you start exclaiming. To be precise, the UK's biggest pawn broking co. Stop blushing, mate. It's pawnbroking I'm talking about. Gold, silver, watches, all sorts. And the company in question is H&T PLC.
Oh,
Ticker
yes.
symbol HAT. Currently priced at £3.62. 52-week range of 305. Back to January of this year, sorry. And December of 6 of 2023 was its high at £4.74. Market cap of 161 million, P of 7.3, and a dividend yield of 4.81. Why am I talking about this one right now? The cost of inflation, interest rates, living crisis, higher fuel costs. We had a recent spike in gold and silver, Henry, as well. I think you noted that because you were going to these markets, weren't you, and thinking, what can I get? I'm not. And you're like, I'm not selling anything. Not selling anything. So yeah, and the recent half-year results were really good, and I just think if they saw profits in the half year recently rise by 12.5% from the half year in 2023, and this was before the spike in gold and silver. Yeah. And before we started saying, actually, inflation is now not going any lower, it might be going up. And interest rates may not be going any lower, they might be going up, next year. I'm just thinking this could be a very interesting pick. So, and the read across from their other companies that are in that sort of space has been positive. Their pledge book demand is still strong. Gross advances up 14%. Retail sales, which is them, buying and selling stuff that people have left with them or have sold to them, it's up 27%. And I just think the pawnbroking is one of them unloved sort of areas that people don't want to be involved with. So I just think it's one of them unloved sort of sectors that could become quite interesting next year. The risks and also what people don't like about this area is the risk of them being involved in anything that's stolen, obviously. And there's always a risk that people are up to no good and rock up and say, yeah, my gran held this. I haven't got any proof that they held it, but this is my granny's and I don't want it. So I'm not going to say much more about that. And obviously, there's an FX risk as well regarding stuff. So I'm not going to say much more about that one. I just think it's a very interesting, off the radar sort of play, exposure to all those sort of things, gold and silver price.
Whether you are an experienced or new investor, you know how valuable it is to conduct portfolio enhancing analysis and to have easy access to data that will give you the edge. As a Twin Peaks Investing podcast listener, you can access an exceptional offer from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. This special Twin Peaks offer is available to new subscribers only, and you can subscribe using the promo code TWINPETES. The incredible and exclusive offer means that monthly subscribers will get their second month free, and annual subscribers will get their 13th month free. Sign up and subscribe today using the Twin Peaks promo code, and you can save up to £69. Visit sharescope.co.uk for further details and subscribe to the investing and trading analysis and data you need.
Well, I'm gonna hit you. I remember where I was a couple of years ago. I was walking down the road. I was on the way to work. I was listening to a Twin Peaks investing podcast with you and Wheelie, and you mentioned I've forgotten the name, IPF, Interpersonal Finance.
Yep. Yeah.
And I still remember Wheelie going, I'm really surprised at you talking about that, because I think, they're seen as a bit of an exploitative business, this kind of high value, high interest rate lending, and that's not what you're about at all. I'm really surprised at you. And you said, yeah, I know, it's not really usually the sort of thing I go for. I was just talking about it generally. And now here I am saying the same thing again. Because so H&T Group
during the period of time that I talked about,
I've got a bit of a nuanced view on this one, right?
Yeah.
Are pawnbrokers exploitative? No, I don't believe that they are. Right? I'm not gonna tar an entire industry with that brush, right? But they do tend to attract people that have got nowhere else to go. If you ask people, do you want to have to pawn this item? No one's ever going to say yes. They're not walking in there. They don't wake up in the morning thinking, oh, yippee, I've got to pawn Gran's watch or, the car or whatever it is that they're getting rid of. And when they have to buy it back, they have to buy it back at quite a significant interest rate to have borrowed the money in the first place. So there is this sort of slightly, I'll use the word exploitative because I've not got a better word for it, but slightly controversial dynamic to it. But putting that aside for a moment, this operates in quite a niche financial sector. Now, I think there is some regulatory risk potentially. We've just seen the FCA clobbering vehicle financing dealers. So people were walking into brokers. They were taking out a loan for 30,000 for a car. It turns out part of it was going in commission to the broker and they weren't being told. The FCA has gone bananas. We've seen all sorts of horrible fallout across the markets on that one. Well, what if something similar happens with the pawnbroking industry? If I can ask the question, does anybody really want to pawn their possessions? What's stopping the FCA or the new government from doing the same and saying, right, go and shine a spotlight on them? And who knows what they'll find when they do. So there's a bit of risk there.
I agree with that, but I think there is one of the oldest trades in the world, which we're not going to talk about, and then there is the second longest industry in the world,
pawnbroking.
Yeah, pawnbroking. I don't think they're going to go there, Henry.
Yeah, you could be right. I mean, it's an interesting business in that, if we're talking about unloved, undervalued players, there are H&T shops all over the place. They're all clean, they're well lit, they're well staffed, they've got an interesting selection of stock in there. I mean, I browse in H&T because just occasionally they misprice things and you can get an absolute steal in them. But having said that, is it really undervalued? It's a retail facing business. And it's heavily reliant on gold prices. They've got a big chunk of revenue that comes from gold pawnbroking and gold trading. And their ability to generate a margin on that's quite important. I don't know who would snap them up. You could get a private equity firm maybe. But as an independent entity on a PE of, I think you said 9, was it?
7.3.
7. It doesn't look it doesn't look wildly undervalued to me, and it doesn't look wildly overvalued. It looks if I was looking at it today to purchase, I'd be happy with the price I'm getting.
Two
So
opinions make the
I'm
market,
ambivalent
Henry.
on that
Two
one.
opinions make the market, mate.
Ladies and gentlemen, I should also point out that in the last couple of weeks, I've got clobbered on Vistry, I've got clobbered on Team Internet Group, I've got clobbered on S&U, right? So my strongly held opinions here, just ask yourselves, out of the two of us, who's been getting a kicking from the market more? Because I'll hold my hands up and say it's not Peter.
No, we've all been having a kick in, mate. We've all been having a kick in. No, but very valid points, Henry, as always, mate. And I appreciate those points. And this is the beauty of having two of us on the pod, to look at stocks and look at them from a different tangent, and then ask our listeners, global listeners, to go away and look at it from another tangent again. And to make sure that they're happy with whatever they're researching, because once they've done their research, it's up to them whether they make a purchase, not us. We're not tipping. We're recommending the research, not recommending them to go and buy it. It's not about the stock performing in the next week or the next 6 months. It's an idea that may come to fruition at some point.
If I was asked to sum up H&T, really, I mean, it is an interesting investment opportunity. Just because I don't think it's wildly deep value or it's got these risks doesn't mean it's not an opportunity. I mean, if you want exposure to something that's potentially quite counter-cyclical, when the economy is not doing well, I guess more people go out and pawn their possessions.
Yep.
Therefore, revenue would go up. So in theory, it's a reasonably good diversifier. They're not reliant on those economic cycles. They are more tied to the gold price than other types of business. And so, depending on your portfolio and your circumstances, that could add an interesting element that you're not getting exposure to elsewhere. It's a bit like Helios. It's about trying to find that angle where you go, well, I've not already got this and I want some exposure. That's what diversification is really about, not just buying 30 retailers and telling yourself you're diversified.
Very good point, mate. Very good point. I don't think anyone's going to come in and buy it, but then again, I don't think anyone's going to come and buy Direct Line. And look what happened. We'll see it pop on Thursday by
God
20,
knows where that's going to end up tomorrow.
Yeah. Okay, so I've got one more stock from you, mate, and then I'm going to try and go and get myself a hot toddy and crawl back into my bed.
I was going to say, I can see you dying on screen here, so I'm going to keep this one brief, ladies and gentlemen, because if we lose the other Pete, you are all in big trouble.
Don't make me laugh,
stuck
mate,
with me
because it just triggers my cough every single time.
Gosh. So briefly, one name that caught my attention, and just because it's had a trading update, it's a £2.7 billion market cap company in the media and entertainment space. They develop, they own, they manage, and they distribute the rights to content which are delivered through three main brands. The business, of course, is ITV. The ticker is ITV. Now, the three main brands I mentioned are ITV Studios, streaming, and broadcast. And they've got effectively these bits that work together. So most people think of ITV and they think of the television channel. Actually, ITV is a lot more diversified than that. The group business, the studio business, creates and owns the rights to different media content. So they commission and they write their own scripts, and then they produce shows based off the back of that. They broadcast those shows both on their own channels and on other media platforms. And they've also got quite a large historic catalogue of British media content, which is shown all around the world. You might find it hard to believe, but actually British TV is quite in demand around the world. We've got quite an impressive back catalogue. If you go around Europe, a lot of people learn their English from watching old 80s and 90s British TV shows. Now, they get their revenue from not just the production and the broadcast of these shows, but they have advertising revenue. They have commercial and creative partnerships with other organizations. They have subscription revenue to various media platforms that they own. They run competitions through which they get revenue. And they also get third-party revenues from people that want to use their content and use it on their own platform. So the thing when I started looking into ITV really is it's a lot more than just a media channel that is on your TV in England. Actually, this is quite a large, diversified media conglomerate. Now, in their latest update, they've indicated that they've had some headwinds. There were writers' strikes over in the US, and I think the Actors Guild also went on strike, and that impacted production. Yeah. The share price has been weak, and their studio revenue year to date was actually down 20%, which wasn't a great start. But they're on track to deliver record earnings before income tax and depreciation, otherwise known as EBITDA, in 2024, because they're becoming more efficient as time goes on. And they've got a significant delivery schedule forecast for the next 3 months. So although they've had, a short-term blip, actually long-term, they look like they're picking up a bit of speed. So they're on a forecast yield of, I think it was 6%, something like that, 6.5%, and forecast earnings per share growth of 12.5%. Now, I can't possibly go into the ins and outs of the whole group in the few minutes we've got left. And if you don't know the media industry, I wouldn't necessarily recommend starting with ITV. It's quite a complicated business. But it's definitely one, if you want some exposure to the media sector, I think this is a name that is potentially undervalued and could get snapped up by a foreign broadcasting agency or a private equity firm. There's a lot of value there. It's cash flowing. It's profit making, and it's not at a particularly taxing forward PE either. It's on a PEG ratio of 0.7, which indicates it's priced at reasonable value. Shares are available at 71p. If you go back to 2019, it was £1.50. So I think there is some margin of safety there. So listeners may like to go away and do a bit of reading into ITV.
Yeah, it's an old former holding of mine, Henry. I sold it back in June 2019 at just shy of 108, and it's ebbed and flowed since then. Obviously paid dividends as well since then. Still 37 pence below where I sold it. Rumours out last weekend, was it last weekend that people were looking at it again? Last Saturday, saying potential suitors are again circling ITV. Britain's biggest terrestrial commercial broadcaster, after a prolonged period of share price weakness and renewed questions about its long-term strategic strategy. It's got a lot of money to invest into the business to turn over future revenue, and it's always been that struggle of how much do they invest to get a return on it. But basically saying at the weekend that CMC Capital Partners and a major European broadcaster thought to be France's group TF1 were amongst those potential bidders looking to make an offer. And also, Redbird Capital owned All 3 Media and Media Van, which is backed by private equity giant KKR, were also on the list of potential suitors for the ITV Studios production arm. So yeah, sum of parts, it's easily worth more than £1, maybe more. It's whether or not someone's going to give you a good 50% premium on this, Henry, with a takeover, which is possible. And you spoke about the back catalogue, which has got a huge value on it, which I don't think people often think about. So it's a good quality company, good brand, well regarded, unloved, has been for a long time. It's been a perennial takeover stock, maybe for about 10 years or more. So at some point or other, it's either going to sort itself out or it will get subsumed by somebody else. Because we know media barons love to own media companies so they can control the politics of what's going on. Oh, did I say that? Yes, I did. So yeah.
I can tell you're not feeling well because you keep driving me straight at cliff edges here.
Sorry, mate. Oh, I'm struggling. But yeah, good call. If a takeover happens, it will be nearer to £1, if not more. So a good 50% there if it happens. Or, and I always say this to people as well, be mindful when you see the Sunday or the Saturday takeover rumours that somebody might be just trying to exit the stock. A large entity spoke to friends in various different media outlets and gone, I need to get out of this stock. Chatter, chatter, chatter. They're going to pop on Monday or Tuesday and they're out. It create liquidity, and we're then going, oh, it's going to go for £1 or it's going to go for more. Goes up 5p, they're out for an extra 5p and they're gone. And then nothing happens over the next 3 months, and the share prices peter below where the rumor started. So be mindful of that. Oh, there you go, Henry. But good call on that one. Not sure what else to add to that other than more takeovers are coming, more profit warnings are
More
coming.
takeovers
Sadly,
are coming. I think unless you'd got another share you wanted to share, I'd got a little thing I wanted to wrap up with actually before we go.
keep it clean, Henry. Keep it clean.
Of course, I'm not you. No more picking bottoms, Peter. He's off, ladies and gents. So,
don't.
We talk about charity a lot on this podcast, and we are doing a fundraise for Centrepoint, but I don't want to talk about Centrepoint specifically before we wrap up this podcast. I actually want to talk about a big hero of mine, Warren Buffett, who is the founder of Berkshire Hathaway, the big investment conglomerate over in the US. Now, Warren Buffett is an incredibly advanced age. He's in his 90s, and we sadly lost Charlie Munger, his business partner, not all that long ago. I've got Charlie's book, Poor Charlie's Almanac, on my bookshelf. I've got, I don't know how many books about Warren Buffett, which I read over and over again. I think he is a wise and kind and, well, there you go. Actually, there we've got it behind Peter. I've got that one as well, the Warren Buffett way.
Yeah, brilliant.
He's a wise and kind and thoughtful and generous man, and you can read his works at length. He freely writes, and over the weekend he actually published a letter about his charitable donations. He's actually giving away a huge 99.5% of all the money he's got. Bear in mind he's a billionaire, so this is not an insubstantial amount of cash, but since he made his pledge to give away so much of his wealth in 2006, he's been successful in giving away about 56.5% of all of his shares in Berkshire Hathaway. We're talking tens of billions of pounds worth of shares given away to good causes. They've not gone to friends and family and, spent down the pub.
Brilliant.
Now, I wanted to read a couple of quotes. The letter came out on the 25th. If you search for it, the Warren Buffett news release, charity news release, you'll find the letter. But there were a couple of quotes I wanted to read from it that really, really made me feel quite poignant this morning. So if you'll indulge me for a moment. Father Time always wins, but he can be fickle, indeed unfair and even cruel. Sometimes ending life at birth or soon thereafter, while at other times waiting a century or so before paying a visit. To date, I've been very lucky, but before long he will get around to me. There is, however, a downside to my good fortune in avoiding his notice. The expected span of my children has materially diminished since the 2006 pledge. They are now 71, 69 and 66. I've never wished to create a dynasty or pursue any plans that extended beyond my children. I know these three well and I trust them completely. Future generations, however, are another matter. Who can foresee the priorities, intelligence, and fidelity of successive generations to deal with the distribution of extraordinary wealth amid what will surely be a far different philanthropic landscape? Now, the reason I've read this quote out to you is not just to extol the virtues of Warren Buffett or to feel sad about the fact that Warren Buffett has had a long and full life that will one day draw to a close, but it's actually to make our audience think for a moment about why they're gathering money, why are they investing, and what do they want that money to be used for. Now, Peter and I encourage audience members to donate to a charity of our choice in exchange for listening to the podcast. The page is justgiving.com/page/Twin Peaks Challenge 24. Now, if you'd like to donate to that page, you surely can. But think for a moment about what the rest of your wealth will be used for, the impact it will have on the world, the impact that it can have on the world. And I just wanted to sum up today's podcast, this week's podcast, by reminding you that one of the richest men in the world, worth over $150 billion, is doing absolutely everything he can to give his money away as fast as he can, so that it goes to the causes that he cares about, rather than who knows what in the future. Just some food for thought, but I do recommend looking up the letter and giving it a read. It's only 4 pages. It's well worth your time.
That's brilliantly said, Henry. I think there's always been a thing with regards to where I grew up and the environment I grew up. And it was often said, and it's still said up north, that those that have the least give the most. So it's fantastic to have an example like Warren Buffett, who's one of the richest men in the world, giving so much, a significant wealth. And I think what happened when he started that back in 2006 is that he inspired others to do the same. I think Bill Gates did that. I think forget her name now, so apologies. The former wife of Jeff Bezos was doing that with her money as well, and has given absolute astonishing amount so far away. So if we can inspire other people to do it, which is what Buffett has done across the world, then brilliantly. And if we can inspire others to donate to a charity, it doesn't have to be Centrepoint, then we're doing a good job. Because all we're asking people to do is pay it forward. It's a lot of work. Everyone was commenting at Mello about how much they appreciate how much work we put into this pod. The fact that it's been going now for 6 years, and it is a lot of work. But what we're trying to do is encourage people to become better investors, to learn from our mistake, Henry, and mistakes, plural, multiple, and to pay it forward. And if they just donate a fiver to a charity, any charity, then it benefits so many people. I mean, Centrepoint's going to be massively busy this year. It's already had temperatures drop into -0 around various different parts of the country already. So can we support them? Yeah. Will we support them? Yeah. We're going to get to $4,000, I think, by the time we finish on the 31st of December with this particular charity fundraise. And they'll be absolutely thrilled because they'll be able to help so many youth up and down the country with that. So yeah, we'll keep on doing what we can do. And all we ask is that you guys, ladies and gents, do what you can. It's just one less pint, or in my case, one less rum, or another slab of mince pies, of which I've already started eating. Yeah, so just make a donation if you can. Last thoughts, Henry?
That's everything from me, Peter, other than I hope you get well soon.
Yeah. I'm hoping my head will be able to actually stand on its own right by the time I get onto the next pod in 2 weeks' time. Ladies and gents, a big round of applause. You can cheer wherever you are listening to this, other than unless you're driving, by the way, for Henry Viola Hare, my co-host. A huge thanks to Paul Hall, who helped us do an absolutely fantastic live Mello pod, and Matt Belly of ShareScope, who helped us to do that as well. And thank you all that attended. We had basically a full room, bar the odd seat. And to have Gervais Williams in the room, I was like, whoop, 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 hello. We've got some royalty in the building, as well as the progressive research team were there as well, which was quite profound as well. And just to meet so many wonderful people at Mello. And I think the beauty of it is that lots of good people are not on social. Lots of people are moving to Blue Sky Social, fine, but lots of people are not on social whatsoever. So it's brilliant to meet them. I have some plans for next year for myself and Henry to do some bits and pieces. It'll be a lot of work again, but we'll keep you posted, folks. Keep in touch with us. Give us the feedback on whatever platform you're using, or email myself or Henry, and we'll always respond to you guys and ladies. And we just want to thank you ever so much for your continued support. And we'll see you in 2 weeks' time, which will be December. Everyone's getting the bunting out and, Christmas decorations and all the rest of it. I'm going to say adios now and go and get some food and some prescription to dose myself up for another night's sleep. And I hope to see you guys when I'm feeling a bit better. Henry, thank you for being an absolute trooper again, mate.
My pleasure, Peter. My pleasure.
Okie dokie. Ladies and gents, take care and God bless you all.
This Twin Peaks Investing podcast is brought to you in association with ShareScope, the UK's #1 investment data and analysis software for private investors and traders.